The crypto asset market is volatile and risky, but also potentially lucrative if you have the proper strategies in place. That's what this section is all about. By the end of this section, you'll be able to develop a strategic trading process, overcome biases, explain why HODL, holding on for dear life, is just not a strategy. You'll also be able to identify trends using price and time, summarize why the trend is your friend, and how to draw a trend line. There is a saying in trading that goes, if man was always right, he'd own the world in a month. But if he never learned from his mistakes, he'd never own anything. I'm going to talk about some common mistakes that traders make that you need to identify if you're making them in order to improve on them. So most common mistakes, the first are position size too big. And in the crypto markets, this is essential because in 2017, Bitcoin rallied 1,400%. However, during that rally, we saw 7 pullbacks of 20% or greater. In fact, in the last few months, Bitcoin dropped 60%. If you have a position size too large, it makes it very difficult for you to stomach that volatility. Next, no edge. And what I mean is that a lot of new traders just go in the markets, they see things going up, and they just buy them. They don't really think about where to buy them, or how to buy them, or where to exit. So this is a common mistake that a lot of traders make, and we'll talk more about exit strategies in another lesson. Another common mistake is overtrading. Now the problem is you may have gotten shaken out by a trade, and now you want to get right back in and make the same mistake again. So you don't want to overtrade because the commission costs are going to reduce your long-term returns. Another mistake, trading the junk. And I'll show a few charts in a second, but by junk, what I mean is an asset that moves up exponentially over a short period of time, and you might be holding on to something that really just has speculative value. We've seen in the crypto markets in the last year, there's just been a wall of money moving into an asset class that has a very limited supply and a limited amount of assets to invest in. So we've seen these exponential moves. And lastly, too much leverage. Now, if you're trading on the BitMEX exchange, you can get 100 times leverage on Bitcoin trades, or if you're buying crypto with a credit card, you're leveraging yourself. So let's go into a few charts so I can demonstrate what I mean by this. So this is a chart of a crypto asset called Verge. And this is a price chart of its relationship against Ethereum. Each of these candles designates 1 day in trading. And this is on the Binance exchange. Now you'll notice that in Verge, in mid-December, something happened or some catalyst appeared. And the price of Verge went from 2,500 sats all the way up to almost 50,000 sats. So in a short period of time, and this is just a few weeks, you had a 20 times return on your money. Now a lot of traders might have gotten into this chart after it went up 3 or 4x and bought around here. Now the problem is if you have no exit strategy, and this is purely speculative, where do you sell? So when you start trading assets like this that are extremely volatile and they start moving down, there's a tendency to kind of hold on to them for too long. And we'll talk more about exit strategies in the future, but what I want you to notice is that when you see something that's moving up as rapidly as Verge, it's not the time to buy, it's really the time to sell. Another example is Sia Coin. And this is a chart of Sia Coin versus the dollar on the Bittrex exchange. Again, each of these candles designates 1 day's worth of time. And Sia Coin was priced at about 2.5 cents or 3 cents here in mid-December, and it went up to 12 cents. This is a 4x return very rapidly. But since that move, there was not one up day for about a month in Sia Coin. So it's important to keep in mind, if you're buying any of these extremely speculative assets, where are you going to get out of them? Because like we've seen in previous lessons, there's no utility value in these coins. They're just purely speculative assets. Technical analysis helps us identify price trends over time. There's a couple key things I want to note about technical analysis. First, you want to be able to spot the trend. And what I mean by that is you want to identify if the market is trending upwards or it's trending downwards. Perhaps the market's even just going sideways. Next, entries and exits. So technical analysis can show you where the market has support and where it has resistance. And if you use these levels, you can identify where you should buy and where you should sell. Technical analysis also helps you control your risk. So because you've identified where these support and resistance levels are, you can set up buy orders and sell orders at the appropriate points. And lastly, technical analysis can help you avoid ruin. If you follow a technical analysis pattern and you're disciplined about it, over the long run, you're putting reward more in your favor and helping to minimize your risk. So let's go into a few charts right now so I can show you some uptrends and downtrends. Now you're looking at a chart of Bitcoin versus the US dollar. Every one of these candles represents 1 day's worth of time, and this is on the Coinbase exchange. Now you'll first notice that the date here starts back in summer 2017, specifically in August. And you'll note that the price of Bitcoin was trending higher throughout most of 2017. Now this uptrend ended in a classic, what's known as a blow-off top. And so think of this from an investor's perspective. First, you see the prices trending higher over time, and then this signifies to other people that prices will not go down again, so they buy at a much higher price than they probably should have. Basically, the person who is buying Bitcoin at 20,000 in an uptrend here is not really buying Bitcoin at 20,000. They're buying the belief that Bitcoin is going to 100,000 or 500,000 or a million. So you have all these high hopes and expectations that happen towards highs. Now, I'll note something about the crypto markets that's different from other markets is that they've gone through this rapid evolution. We've had 5 or 6 major bull and bear markets in the last decade. And that's not something that stock markets or Forex markets or bond markets go through in such a short period of time. Now, after you had this blow-off high in Bitcoin, you started the downtrend. And this is when prices quickly declined right off the bat, and this scared a lot of people out. So investors who had bought at this point of the chart are now worried that the prices aren't going up any higher, so they sell. And one thing that's indicative of downtrends is they're not as smooth as uptrends. You can see in this chart that there are a lot of bounces and a lot more volatility on the way down than there were on the way up. And that's something that is native to a bear market where the price doesn't go smoothly either way. They say that bear markets kill both bulls and bears because of the volatility. So I'm going to show you another chart of Bitcoin, and this is a daily chart on Coinbase and zoomed in a little bit more. So the frame of this action starts in June of 2017 and it ends in December. Now this is how Bitcoin was trending throughout most of 2017. And you'll note here that it doesn't look as smooth once you start zooming in on this market. It's actually very volatile. So you had Bitcoin hit a price high of around 5,000 in September, but then just 2 weeks later, it dropped to about 3,200. So you're looking at a 30 to 40% decline in just a matter of weeks. Now, people who say that they bought Bitcoin in 2017 and made 1,300% gains, you have to keep in mind that it wasn't easy. There was a lot of volatility. So if you didn't buy this market at the right points, you could have lost a lot of money. Now, we've noted in technical analysis that prices tend to trend over time. But there are different types of trends, and let me explain. The first type of trend is the primary trend. And this can be a long, drawn-out, secular bull or bear market. For instance, in the stock market, we've had almost a 10-year bull market. The second type of trend are the secondary trends. And this can be a counter trend to the primary trend. So if you have a long bull market, in the middle of it, you might have a 20% pullback that lasts a couple months that signifies a secondary bear market. The next type of trend are the short-term trends. And these can last weeks to maybe months. And they can be either the same as the primary trend or counter to it. And lastly, you've got the intraday trend. And these are really short-term moves in the market. For instance, you could have a stock market that rallies 200%, but at the same time, you can still have days that drop 3 to 5%. So just because the trend is heading up doesn't necessarily mean there can't be any counter trends. So let me give you an example of Bitcoin. And this is a chart going back to 2011. and we're looking at Bitcoin here on a log scale. And what this log scale means is that on the y-axis, the distance here is separated by percent moves. So it means that a move from, let's say, 100 to 190 is going to be the same move as 1,000 to 1,900 on this chart. So you'll notice that Bitcoin has been trending higher. The primary trend has been up over time. Since 2012 to 2018, this trend is still intact. However, there's been some very vicious counter-trend moves during this time period. You can notice that in 2013, there was a 70% pullback. In 2014, there was another 60 or 70% pullback. Even in July of this year, we had a 30% pullback. And even most recently, you can see a 50% pullback in the price of Bitcoin. So just because the trend or the long-term trend is going higher doesn't necessarily mean you can't have any counter-trend moves. Now, when you're looking at a price chart, it's important to keep in mind, you're not just looking at the asset that's being charted, you're looking at the behavior of the market participants. And we've seen over time these market cycles come and go, and they really resemble other market cycles of the past. There are a couple different ways that you can look at a chart or identify price trends. You've got line charts, bar charts. Today specifically, in this course, we're going to focus on candlestick charts. Now, candlestick charts have been around for a while. They originated in 1600s in Japan to study price changes in rice. In the early 90s, they were brought to the United States by a guy named Steve Nissan in his book titled Japanese Candlestick Charting Techniques. Now, let me give you the quick basis of them. There are red and green candles. Sometimes these can be represented as hollow bodies or full bodies. But essentially, a candle shows you where the price has gone given a specific period. So if I show you a daily chart or a 1-hour chart, each of these candles represents that specific time period. And the way you want to look at this is this. The entire price move that's happened during this candlestick is from the top of the wick to the bottom of the wick. Now, the body of the chart is key because this bottom left on a green candle represents where the price opened for this time period. And the top right of the green candle will tell you where the price closed for that time period. You can apply the same thing to the red charts. Now, the red charts means price moved down. The left top bar will represent the opening price, and the bottom right corner will represent the closing price. So those are a couple key things to keep in mind when it comes to price charts. Now, let me go into a couple examples of price charts with these charts right here. Now, here we're looking at a chart of Ethereum versus the US dollar, and these candles represent 15 minutes of time, and this is on the Coinbase exchange. And the first thing you'll notice is that candlesticks come in many shapes and sizes. Here's a big down candlestick in red. Here's an up candlestick in green. Here's one that's all wicks right here. But one key type and behavior I want to point out is known as the bearish engulfing candle. Now, this happens when the price of the new candle goes higher than the price of the previous candle and then closes below the low of the previous candle. So this is a bearish engulfing pattern, and it usually signifies that prices are going lower. And the reason for this is you have to put yourself in the shoes of the other market participants or the investors. Let's say you were an investor that bought this green candle here expecting price to go higher. Now, all of a sudden, this big seller walks into the market and knocks the price down lower. So if you had bought here on the expectations that prices would continue trending higher, now you're looking at more sellers. And so that's bringing out more people who are selling because now prices have reversed. On the flip side, we have the bullish engulfing candle. Now, this is a chart of Bitcoin versus the US dollar. Each of these bars represents 240 minutes, which means 4 hours of time. And this is on the Coinbase exchange. Now, a bullish engulfing candle is similar to a bearish engulfing candle, but it signifies that prices are ready or perhaps might be moving up. So right here you have a red candle, and the next one, this bullish engulfing candle, actually drops below the price of the preceding candle and then closes above it. So it closes up here. And this signifies to other market participants and other traders that prices might be rising. And just as you're looking at, prices did rise over time. They went up. This candle closed at 6,000, and then by the next day, prices were at 6,700. So these are two simple ways to use candles to identify changes in price. Now, when you're trying to figure out what type of chart you should use, you need to keep in mind that there are different types of scales. Now, the first type of scale is known as linear, and this is the most common chart form. And what this means is that the price axis and the time axis are on equal plots. The second type of chart that you want to use in the crypto markets is known as the semi-logarithmic. And what this does is it's going to show you a percent price change that's the same all the way up on the y-axis, and I'll demonstrate in a second. The rule of thumb that I use for crypto markets is if there's a price that moves over 100%, I want to use a semi-log chart to identify that price. And let's take a couple look at a few charts to see how this works in practice. Right here, you're looking at a Bitcoin chart. This is Bitcoin on the Bitfinex. And you'll notice this is not a candlestick chart right now. This is actually an area chart. So the area chart is basically a line chart with a shaded area below it. And this is a good way of illustrating a longer-term chart trend. It starts in 2015, and you can see this is about 3 years worth of data. And most noticeably on this chart is that the y-axis moves up in a linear fashion. Okay, so from 0 to 2,000 to 4,000, all these numbers jump in the same arithmetic formula. Now, you'll also notice that in 2017, prices look like they skyrocketed in Bitcoin. I mean, the market started rallying throughout the first half of 2017, and then they really took off. And that's true, prices did jump. But if you think about things on more of a semi-log area, this rally is no different than ones we've had in the past. In fact, not much different than ones we've had in the last few years. So a semi-log chart on the y-axis gives us a percent change in prices. So if you start here at 210 and move up to, let's say, 420, which would double it, it's equivalent from moving from 2100 to 4200 on the same graph. You can see the distances are roughly the same amount. And this will show us that Bitcoin, even though the move has looked parabolic on an arithmetic chart, it's not much different than the trend has been since all the way in 2015. So it doesn't look as dramatic on a semi-log scale as it does with an arithmetic chart. And it's important to look at these semi-log charts because they'll notify you and show you that these trends tend to be the same over time. Even though something might look parabolic, it's happened in the past and probably will happen in the future. Now, when you think about technical analysis, it's going to show you a chart and the price trends in that chart of the asset. But you also have to think about technical analysis as understanding the behavior of the market participants. Now, we've seen over different market cycles and asset classes that charts and prices are determined by people's beliefs. And humans have the same greeds and fears no matter what the asset class is. Whether you're trading the stock market or the crypto market, those fears and greeds will always be the same. So over time, we've used technical analysis to give us not so much a prediction, but more information as to where prices might be heading next. So there's a couple simple chart patterns that I want you to know about. And I'm going to start by the double top and the double bottom. Now, in a double top, a price has been reached, then the price drops, hits that same price again, and falls. That's a double top. The double bottom is just the reverse of it. The next simple chart pattern is the head and shoulders reversal. And this happens when prices reach a new high, they drop, and then they fail to break that previous high. So it looks like a head and shoulders. And I'll show you what that chart looks like in a second. And lastly, you've got the rounding bottoms. Now, this chart is an accumulation period. And it's usually when there are buyers moving into the market that aren't letting the price decline. And it usually turns into a big bull move in the chart. Now, let me look at a couple of these charts to show you an example of what I'm talking about. The first chart we're looking at here is a chart of Bitcoin versus the dollar. It's a 15-minute price chart on the Bitfinex exchange. Remember, each of these candles here represents 15 minutes in time. And what you'll notice is that in this short-term period, prices sold off and hit a double bottom. the price of Bitcoin dropped below 9,300 right here. It rallied and then sold off and hit a double bottom. So anyone who's trading this noticed that the downtrend looks like it was reversing. So they came in and bought and pushed the price higher. That's indicative of a double bottom. Now, a double top is exactly the opposite. And this is, again, a 15-minute chart of Bitcoin versus the dollar on the Bitfinex exchange. So in this case, the price of Bitcoin rallied to 10,500, then it sold off, and then bounced back to 10,500, forming a double top. And then immediately after that, you had a huge drop and a downtrend. And so that's a double top. Next, we've got a head and shoulders. And this one has been pretty predictive in the Bitcoin markets. And there's a couple things in head and shoulders that I want you to notice. First, when Bitcoin breaks to a new high up here, this is considered the head. Now, as it sold off and it bounced again, it formed this pattern that looks like a shoulder. That's why we call it a head and shoulders. Here's the head, and here's the shoulder. Now, the key level here is the neckline. And the neckline starts from the first bounce. So when Bitcoin bounced at 12,774, it formed the neckline. And you'll see once this neckline was finally broken, prices dropped very rapidly. So this is a $3,000 drop in Bitcoin. And then it bounced. But what's key about this chart is that what once was support at this neckline then turns into resistance. So you can see there was a battle going on here with the buyers and sellers. So this was support during the neckline, but once it was broken, it became resistance. Prices were unable to get above 12,774. Another chart of Ethereum head and shoulders. This is Ethereum versus the US dollar. You've got a one-day time frame for each candle. This is on the Coinbase exchange. And this is the head, and this is the shoulder. And you can see prices drop down here to this neckline. Same thing that we saw in the Bitcoin chart, where when prices finally dropped below the neckline, there was a big flush followed by a rally. However, this area here at 983, which was once support, now becomes resistance. So people who were once buying at this point are trying to sell because they were buying at support, accumulated Ethereum, and now they have some to sell at the same price. So that is a classic head and shoulders pattern. Now lastly, I want to show you what a rounding bottom looks like. Rounding bottom is indicative of prices moving higher. And you can see there's a little bit of a curve to this as it's trending higher. And what we've seen with rounding bottoms is when they finally break to a new high past the old high. So the old high here happened in June of 2017, when the new high in this Bitcoin versus dollar was finally broken in December. You saw what's known as a parabolic move. So as soon as the previous high was broken, then buyers quickly rushed into this market and sent the price higher. So those are just a couple simple price charts that you need to be familiar with when you're looking to analyze the crypto markets. Remember, in crypto markets, as in any markets, the trend is always your friend. You need to determine which direction prices are moving in order to put in appropriate buy and sell orders. Now, mistakes will be made when buying and selling, but it's professionals and better traders are able to quickly correct those mistakes in order to profit in the long run. So let's begin by talking about a couple moving averages. And what are they? Basically, they help you identify which direction the market is moving. The first consideration is what time periods should you choose? Now, I prefer using the time period that are chosen by most market participants because then I know everyone's looking at the same signal. And in this case, I'll use a 20 period, a 50 period, and a 200 period moving average. The second consideration is moving average convergence divergence. And what does that mean? And basically, these moving averages tend to move away from each other or move closer to each other over time. And you'll see sometimes when they cross, that can give us a buy or sell signal. So let's look at some charts right now and get into it. So here's a chart of Bitcoin versus the US dollar. Each candlestick represents 1 day's worth of data, and this is on the Coinbase exchange. Now you'll notice not only do I have these candlesticks, but there's these squiggly lines as well. And what these are represent exponential moving averages, and that's what the EMA stands for. Now, I like using the exponential moving average because it gives a higher weight to prices that are closer to that specific candle. And in this case, I've chosen 3 different time frames. The blue line is the 20-day EMA, the orange line is the 50-day EMA, and the pink line is the 200-day EMA. Now, in an uptrend, these moving averages can give us an indication of where support is. So once this price trend is above this moving average, if it pulls back to the 20-day, that can be a weak support. If it pulls back to the 50-day, this can be stronger support. And then the 200-day moving average should serve as the strongest level of support. What you'll notice about moving averages is even though I'm applying them here to a 1 day's time frame, you can use them in shorter time intervals as well. Now, this chart is Bitcoin versus the dollar in 240 minutes, so this represents 4 hours of time per candlestick, and this is on the Coinbase exchange. And here I've identified the 20-period exponential moving average and the 50-period exponential moving average, the 50 and the 20-day. And what I want to show you here is that at one point in this price history, the 20-day time period crossed over the 50-day time period. So the blue line essentially moved below the 50 period. And when this happens, it signifies the price trend has changed. So if you were to sell Bitcoin here at, let's say, a price of 15,000, you'll notice that once this price moving average, the 20 period went below the 50 period, the prices continued lower for a considerable amount of time. In fact, the price didn't really bottom until 6,000. So Bitcoin went from 15,000 to 6,000 on this. I also want you to notice that if you're selling short Bitcoin, which means you're profiting as it's going down, the best times to buy are when these moving averages really diverge from one another. So when the 20-period moving average diverged, see this difference in these 2 lines right here? This was a good place to take profits. Same thing at 6,000. When you see a big divergence in these moving averages, if you're short, you want to take profits. On the flip side, you can see the uptrend has started to resume a little bit lately because the 20-period moving average, remember the blue line, crossed back above the 50-period moving average. So now this is signifying that prices are trending higher. Now another chart of Bitcoin versus the US dollar on a 15-minute time interval, I just want to show you how these same exponential moving averages can be applied to daily charts, to 4-hour charts, and also 15-minute charts. Same thing here. You see this cross where the 20-period moving average drops below the 50, and this signifies that the trend has changed. So the trend was moving up as the blue line was above the yellow line, and then it crossed over and prices dropped significantly. The price here on Bitcoin when this cross happened was about 11,500, and then it dropped all the way down to about 10,000. So you saw about a 15% drop in just a couple of days. Here's a chart of Ethereum versus the US dollar, and this is a 1-day time frame. So each candlestick, remember, represents 1 day of price changes. This is on the Coinbase exchange. Now I've signified the different moving averages, the 20-period moving average, the 50, and the 200 exponential moving averages. And you also notice here how the 20 period during this uptrend served as support for Ethereum. So each time Ethereum sold off, it touched this 20 period moving average and bounced higher. The few times that it dropped below to the 200 period moving average, now these are great times to buy in this uptrend because you had a price drop that fell from 500 here to about 200 here, so it dropped more than 50% and then rebounded back to 400 or 500. Same thing in this price drop, the 200 period moving average. It dropped all the way down to 200 and then bounced back, and then Ethereum took off and rallied up to 1,400. Now just keep in mind, these not necessarily are these predictive, but they're just really informative. They're just a way for you to analyze the market and think about where are places that you should buy and sell these different crypto assets. Here's another chart of Ethereum versus the US dollar. Again, it's a 1-day candle formation on Coinbase. I've identified these 3 different exponential moving average, the 20, the 50, and the 200. And what we're looking at here is just a closer look at the times Ethereum dropped to this 200 period moving average, which signified strong support. In fact, there are only 3 times during this time frame, so in 6 months, that Ethereum dropped the 200-period moving average, and each of those times you saw a significant bounce in Ethereum. So it bounced right off that 200-period moving average every single time. Here's another chart of Ethereum versus the US dollar. Now 240 means 240 minutes, or about 4 hours, and this is on the Coinbase exchange. And I'm looking at here 20-period exponential moving average versus 50, and I've got a bunch of crosses here going on. I've got a cross of the 20 above the 50 here at a price level about 750, which took Ethereum up to a price level of 1400, so you saw a double. Again, you see how this moving average started in a tight range, but then it diverged. And once these prices start to diverge and they get really wide, this is indicative of a place you want to hit the sell button if you're long. On the flip side, the price drop happened and the 20-period moving average dropped below the 50, and this move in Ethereum continued for a couple weeks here, where it was weaker because the 20-period was below the 50-period, which is indicative of a downtrend. You saw a really sharp cross here in early February where the 20-period moved below the 50-period. Remember, the 20-period is the blue, 50 is the orange. Prices dropped significantly, and you saw the price of Ethereum versus the dollar dropped from 1,100 all the way down to 550. So you're looking at a 50% price drop as that moving average crossed. And more recently, you've seen the moving average kind of turn higher and then back down again. So the last chart here is Ethereum versus US dollar, and this is the 15-minute price chart. So this is shorter time frames, but you'll see that these crosses on these exponential moving averages still hold up over different time frames. So you can apply this technique not only to your daily charts, but also something really short if you want to be a day trader or trade the prices in the real short term. You've got a cross here at 970, which took the price back down to 910 in the same day. And if you were trading this divergence here and you had shorted Ethereum, now this is where you want to start buying back when the price trend of the 20-period average diverges from the 50. And you saw another one of these divergences or crossovers happen right here at 950, and then prices of Ethereum dropped all the way down to 820. So this happened in just a few hours. So there you have it. You can see how these moving averages and their convergence and divergence and crossovers can be applied not just to daily charts, but many different time frames. And always remember that technical analysis is not predictive, but it's informative. So after you've determined the trend in the crypto markets, the next thing to do is to understand whether that trend will continue or it will reverse. And there's some indicators you can follow that can help you with this. The first one I want to get into is the relative strength index. Now, the relative strength index is a momentum oscillator. It basically measures the health of the market, specifically the health of the rally or the health of the sell-off. It's calculated on an index between 0 and 100. And between these numbers, there's some key readings. So a reading below 30 is considered oversold, and a reading above 70 is considered overbought. Now, let's get into a few charts to help us determine this. So what you're looking at here is a chart of Bitcoin versus the US dollar, and each candle represents 1 day of price. And this is on the Coinbase exchange. Now, I first want to point out that I've labeled the exponential moving averages, the 20-day and the 50-day. So when you look at the RSI, here it is below. You can see it bounces above this pink area. And now the pink area right here is calibrated to 70 and 30. So those are the key readings that I mentioned just a second ago. 70 means overbought, 30 is oversold. Now, one thing to know about the RSI is it just calculates what the market is doing, and when it doesn't follow the market, it offers actually a more powerful signal. And what this is called is divergence. So you want to look where there's a divergence between the RSI and the underlying asset. And in this case, I'll break this down. So if we're looking at a price trend that's going higher, and right here you have the 20-day above the 50-day, so things are great, things are bullish. And then you'll notice at this peak right here, the RSI hits a level above 90. Now, prices retreated and then went to a new high right here at about 20,000 of Bitcoin. And this is one of the most powerful signals we've seen in Bitcoin in the last few years. Even though the prices went higher than the prior peak, the RSI actually diverged. The price reading was lower than the previous price reading on the RSI. And what this tells me is that the trend is in trouble because there is not as much bullish sentiment as there was at the previous price high. And what happened after that? The price of Bitcoin dropped about 60%. So what you're looking at here is a chart of Ethereum versus the US dollar, and the time frame is different. So these are 240-minute candles, which represent about 4 hours. This is on the Coinbase exchange. Now the same thing. In this case, the price of Ethereum was dropping, right? However, at this low right here, there was a divergence between the RSI. The RSI dropped to a reading of about 15, and then at this drop, which the price was lower, the RSI was actually slightly higher. So typically, when you're seeing a sell-off, you want to see lower readings on the RSI to know that that sell-off is going to continue. If the price or the point of the RSI diverges from the price, this is a signal that prices have typically bottomed out. And what we saw after this was the price of Ethereum went from about 570 all the way up to 900. Next, here's a chart of Bitcoin Cash versus the dollar, and this is charted on a one-day time frame on the Bitfinex. Now, the exponential moving average, the 20 period, and the 50 period are labeled in green and blue. And now you'll see in this one is that you had a significant parabolic high in Bitcoin Cash. However, this RSI was lower than the previous one, which is actually a lower high. So the RSI actually went down as prices went up. So this is known as a bearish divergence. And this is telling you that prices likely will not continue higher because the RSI is not matching where the price is going. And in fact, the price of Bitcoin Cash dropped over the next couple of months. And it's also noticeable that these signals don't occur very often, but when they do, they give us places to put stop losses or sell orders. Next chart is XMR versus the US dollar. Now, this is a different cryptocurrency. This is Monero, which is an anonymous form of cryptocurrency. And this is a one-day chart on the Kraken exchange. And in this case, we saw the price hit a new high above 440 in December with an RSI reading up above 90. And the next time the price went to break out above that high, it failed, and the RSI was way lower. So this goes to show you that there wasn't as much bullish momentum during this rally as there was at this one. And what happened? The prices went on and dropped about 50% in the next month. So in this chart, you're not looking at the price of a cryptocurrency against a dollar. You're looking at the price of a cryptocurrency versus another crypto. And in this case, you've got Ethereum versus Bitcoin. Each of these candles represents 1 day in price moves, and this is on the Bittrex exchange. Now again, I've labeled the EMA 20 period and the EMA 50 period, with the orange being the 50 and the blue being the 20-day. And what you'll notice here is that the relationship between Ethereum and Bitcoin dropped here in mid-December. But that didn't coincide with a lower low in the RSI. You actually had a bullish divergence here. The RSI hit about 22 at this point on the drop right here in October. However, then in December, prices fell, but the RSI didn't follow. It bottomed at actually a higher low. And so this gave us a bullish divergence and led to a higher price climb over time. So there you have it. And just a reminder, no system or strategy is perfect, but the RSI is an indicator that gives us some sound levels where to buy and sell different cryptocurrencies. Cryptocurrency markets are historically volatile. These are speculative investments that carry a high degree of risk. Now, you may have heard of the huge price rises in Bitcoin, Ethereum, Litecoin, and other altcoins in the last year. In fact, it was common to have price moves of 1,000%, 2,000%, even 10,000% in some cases. However, new investors don't consider that what goes up also comes down just as volatile. For instance, in 2017, Bitcoin rallied 1,400%, but during that time, there were 7 price drops of 20% or more. And so a new investor that moves into the space makes a common mistake of position sizing too big without considering how volatile this asset is. So let's give you a quick rundown of how to think about trading in a volatile market. Now, the indicator I like to use is called the average true range, or ATR. And what this is basically just an average of how much the price has moved over a specified period of time. If you think about ATR, you can use it as a risk framework for where to set your buy orders and your sell orders and also your buy stops. So let's take a look at a chart right now and show you how this works. So what we're looking at right here is a chart of Bitcoin versus the US dollar. These are 240-minute candles, which represents 4 hours of time. This is on the Coinbase exchange. Now, the first thing you'll notice is that the top chart looks just the same as every chart we've looked at so far. Now, below it is a chart of the average true range. And this average true range gives us the range in volatility of the past 14 time periods. So you can apply this 14 time periods to days if you're looking at a daily chart, or for here, these will be the last 14 4-hour periods. Now, average true range is not a static indicator. You can see how it moves up and down, especially when the market's really volatile. So with this sell-off in Bitcoin, we saw the average true range rise to about $700. When the Bitcoin markets are less volatile, the average true range sinks between 300 and 400. Now, these numbers are important because they'll give you an indication of how much volatility you can expect in the price of Bitcoin over a given period of time. So if you were to buy Bitcoin at, let's say, 6,000 here, the average candle, you should expect a 700-point move. So if you're buying something at 6,000, then you should expect that this could potentially drop to 5,300 in the next 4 hours. And so when you're setting stops or putting buy orders in or sell orders, you have to be aware of how volatile the asset is, and the average true range gives you this framework. So in further lessons, we'll show you how to set stops and sell orders using this average true range framework. You may be familiar with buying a cryptocurrency and profiting when the value goes up. But did you know you could also short a cryptocurrency and profit when the value goes down? So what exactly is shorting? Shorting is the ability to borrow a crypto asset, sell it, and then buy it back at a lower price. You never really own it, you've just borrowed it, and so that gives you the ability to buy it back lower. For instance, if you borrow Bitcoin and you sell it at, let's say, 10,000, and the value of Bitcoin drops to 5,000, you've just made $5,000 in profit. And this is key because prices tend to drop faster than they raise. Now, how exactly would you short Bitcoin? First, you have to locate an exchange that you can trade on margin, because on exchanges that you can trade on margin, they allow you to borrow Bitcoin. So the next thing to do is you just borrow Bitcoin and then sell it. And that's what shorting is. So let's take a look at a chart to break down shorting for you. Now you're looking at Bitcoin versus the dollar on a 240-minute time frame on the Bitfinex exchange. And now what you need to do is borrow Bitcoin and sell it and collect for a profit when you buy it back. If you were to sell Bitcoin when this moving average crosses, when the 20-period moving average crosses below the 50, right here at 11,000, and buy back here at 6,000, you would collect a $5,000 profit. So this goes to show that you can not only profit when prices go up, but it's possible to profit when prices go down. So that concludes section 5. Now, just to review, you should be able to develop a strategic trading process in the crypto markets. You should also be able to overcome some of your biases and limitations. And you should be able to explain why holding on for dear life is just not a viable strategy. Additionally, you should now be able to identify trends using price and time. You should be able to summarize why the trend is always your friend. And finally, you should be able to draw trend lines.